Johan Steyn is in our Cape Town studio now to discuss the Chinese trade and investment relationships with Africa. Good morning to you, Johan. I must say I'm very aware of these other continental involvements in Africa, having been to Nigeria over the last couple of days, and one sees delegations from countries, particularly China, moving around. We know China is buying into the African growth story and indeed in some ways stimulating the African growth story. Just remind us of the state of play, the degree of the involvement by China in Africa.
Absolutely. So over the last decade, we've seen this very high economic growth in China, which is predominantly a capital investment-led domestic growth, which translated in soaring demand for commodities. Now, we know Africa and sub-Saharan African countries have got rich endowments of natural resources and commodities, and naturally, China would be quite, interested in getting access to those commodities. So we've seen a massive increase in trade flows between China and Africa, as well as investment flows and infrastructure development. And critically, infrastructure networks are critical for supporting economic activity. So we've seen African countries being able to lift their growth trajectory on the back of this involvement in China. In 2013, Africa-China trade was over $210 billion US, which over the last 10 years, that makes up to about a 30% cumulative annual growth. So yes, China very much willing to engage Africa in that regard.
Johan, there have been some negative perceptions, though, when it comes to China's role in Africa. If we look at the contracts, more specifically with regards to infrastructure contracts or investment, are we seeing the terms in the contracts being changed so that they are more also in favor of the African countries? Is this something that's changing?
Yes, it is. In the past, I think the main critique of China's involvement in Africa from various sources has been their focus on commodities, investing in the mines and only investing in the transport networks which allow them to extract and repatriate the commodities out the country. And they didn't really have a regard for enhancing society or improving living conditions. And China, maybe rightfully so, was interested in getting tangible benefits, but they've emphasized that they prefer partnerships where both parties agree. And I think that's a key point, or where both parties benefit. I think it's an important point because if you look at what Africa kind of lacks in terms of reaching its growth potential, it's a critical shortage of financial and human capital. And these infrastructure networks, so infrastructure development, it's a big thing hampering their growth. And China is a partner that is willing to kind of address those. They have the capacity and the skills to bring the engineering and the architectural skills, as well as the construction ability to the continent and establish that infrastructure development. But also, they have the financial capacity. And that's answering your question, they've been willing to structure the financing of some of these mega projects in a way that is more affordable and sustainable. So in terms of, if you look at an example of the modern railway line in Kenya between Mombasa and Nairobi, the whole project is going to cost about $4 billion US. 90% of that is going to be financed by the Export-Import Bank of China in the form of export credit. Now, some parties have criticized and kind of raised a concern about the sustainability of these higher debt levels. However, we've seen China being more willing to negotiate on and more sustainable solutions, and often at lower cost financing that would be available from the African Development Bank, for example.
Johan, I'm not sure to what extent it's happened in other countries, but when you have a player the size of China with that kind of firepower, the temptation must be to give them what they want, perhaps too easily in return for the investment. And certainly in South Africa, there's a view that we've done down some of our own manufacturers in clothing, that there is Chinese dumping and so on. So you don't want to upset a big investor and potential investor like this. How serious is that as an issue?
Yes, that has been quite an issue, but I think the reality is that the shortage in capital and infrastructure has been just so dire that your African leaders have just been too willing to negotiate with a deep-pocketed player like China, as you've mentioned. And I think it's quite important to consider that, China has obviously wants something out of that transaction, so they want tangible benefits, and they're not really willing to go the aid route, as they see that as unsustainable and creating a dependence. I think the responsibility then lies with the African leaders to kind of represent the interest of your local population, the wider local population, and not mortgage their resource endowments for self-gain. So I think that's a key point there, is that your African leaders need to create the business environment free from fraud and corruption, so that we can actually see some return on investment on some of these Chinese investments, but also then attract investments from other sources, so that they can promote economic growth, industrial development. And critically, they have to make education a high priority, increase industrial development, and then also promote regional trade links, so that you don't have this high dependence on a single trade partner like China, but you can actually promote regional trade and spread that risk, or that concentration risk in export partners.
Johan, obviously China is a big trading partner for South Africa, but there have also been questions raised around the growth trajectory for China. We have had their GDP numbers saying that for next year we're possibly looking at 7% as opposed to 7.5%. So this potential slowdown, what type of impact will it have for sub-Saharan Africa?
Right, so there's been a lot said about the potential slowdown in economic growth in China, and where they're shifting their focus from capital investment to more consumer-driven demand growth. And I think one point to remember is that China is such a massive economy that a slowdown from 7 to 5% still results in a much higher economic delivery than we're seeing in any other region in the world. But coming back to the impact on sub-Saharan Africa, I think it's difficult to generalize, because the impact would be specific to certain countries. As we see a slowdown in commodity demand, like we've already seen, there'll be a slowdown or lower commodity prices generally, and that will impact the finances of some of the countries. Nigeria, for example, with their kind of reliance on oil, will be impacted by lower oil price, and they're going to have to change the way they approach their budgetary spending. But also you'll see countries that have a high dependence on a single commodity, like copper in Zambia, for example, having seeing a larger impact from a China slowdown, as opposed to a country which doesn't have a reliance on a single commodity, like Kenya, for example.
Well, thank you to Johan. Johan Steyn is a portfolio manager at Prescient Africa Equity Fund, talking to us from Cape Town.